Hello and welcome to the Week in Markets. I'm joined by Joe Forward, one of our investment analysts, who's here to talk us through the key events of the week. It has certainly been a notable week for markets where we've had two major central banks meet and give their latest interest rate decision. We've had in the US, the Federal Reserve announced their first interest rate cut. And then we've had here in the UK, the Bank of England also decide on interest rates. So Joe, let's start with the US, probably the most important central bank for financial markets. And markets, I suppose, coming into the week, really already priced for an interest rate cut, the first cut from the Federal Reserve. I suppose the big question was whether it would be a 0.25% cut or a 0.5% cut. 70% price for the latter, 0.5% cut. So Joe, what happened? Talk us through it.
Yeah. So we got a 0.5% cut in the end, which, as you say, it was split between that 0.25% or 0.5%. When we looked at the comments from Jay Powell, essentially they were looking at maintaining the current level of growth, current level of employment in the US, while staying tight enough just to ensure that they're still bringing inflation down. Now, I mentioned unemployment there, and that'll be a key metric really that they'll be looking at. And so unemployment currently sits at 4.2% in the US. Now, they really won't want this to creep much higher. So you've had officials from the Fed actually estimate that unemployment will peak at 4.4% over the next couple of years. So there's not really too much headroom for that to move between now and then. But I suppose something that's encouraging, just earlier this week, you had retail sales data come in, and that actually beat estimates by 0.3%. So just showing that the demand side of the economy in the US is still strong enough.
Yeah, and I would add on that is that it appears that the supply-demand dynamics in the US economy do appear to be coming into more equilibrium. And when we look at the estimates for economic growth, that still appears to be robust. Their projections is for it to remain at 2% GDP for the next 3 years. They revised down their inflation forecasts, and you rightly point out that unemployment is expected to creep a little bit higher. But I suppose the reason why unemployment rate has really been going up is that it's due to immigration. So the pool of workers has actually been increasing rather than we actually seen jobs being destroyed. But I suppose the Federal Reserve coming out with a 0.5% cut, much more meatier, bigger cut than what we've seen previously from the ECB, the Bank of Canada, or the Bank of England, US charging through with a 0.5% cut. And I suppose, what is the market expecting for the rest of this year and into next year?
Yeah, so what the Fed do is actually release something called the dot plot. Essentially, that is their estimate of what cuts will happen, over the next year or so. And essentially what it's saying is for 2024, they're expecting another 0.5% to come off the interest rate. Now, there are 2 meetings left this year, so that could either come as one more 0.5% cut and then one where they just leave it, or it could actually just be 2.25% cuts. So it really depends on what data they see coming in. And as we've said, the unemployment data, the labour data will be key in determining that.
And I suppose, thinking from an absolute level, they've gone from 5.5 to 5. And as you say, expected to take it down by another 0.5% by the year end, and then another 1% by the end of 2025. So interest rates coming down, important, good for markets. Cash rates coming down, so suggests that being fully invested may be more appropriate looking forward. Let's turn attention to the UK, the Bank of England. Anything exciting there?
Well, not necessarily exciting. They did decide to hold rates at 5%, but what I would point out is that they did already cut in August, so they're ahead of the Fed in that sense. So they did made that 25 basis point cut in August. Now, what Andrew Bailey said was that essentially growth and inflation is actually tracking in line with their expectations. So that's positive, and so they're fairly comfortable to leave the rate as it is. What we actually saw today, though, was maybe a bit of strength. So the retail sales figure came out for the UK just today, and that was actually 0.6% above estimates, which is a fair margin of a beat there. So there's maybe not necessarily the need for the Bank of England to cut just yet. Another reason they'll maybe be a bit cautious will just be around the autumn budget. And as essentially, they'll need to get a grasp of just what Labour's plans are so they know exactly how tight or how loose they need to leave monetary policy.
And I suppose before the Bank of England meeting, we had the inflation data at the start of the week where inflation remained at the same level, headline 2.2%, so marginally above their 2% target, slightly below the Bank of England's actual forecasts, all positive there. But when you break out into the different components, goods and services, it's the services side which is making the Bank of England a little bit more patient in its interest rate cutting cycle. Services inflation actually creeped a little bit higher, from 5.2 to 5.6, still double the level of service inflation that we saw 5 years prior to COVID. So this is really making the Bank of England a bit more cautious and is certainly contrasting with that what we've seen from the Federal Reserve this week. Let's finish off in just thinking about how markets have performed. Equities, bonds, alternatives, likes of gold, how they reacted.
Yeah, so obviously we've had some pretty key events this week, one being the Fed decision. So if you look at just what they did on Wednesday after the decision, equities actually, they started opening pretty strong, but then actually by the end of Wednesday, it was almost sort of flat to negative. But then the real sort of big moves we saw yesterday, so on Thursday, you really saw global equities up around 1.1%.
Yeah.
Much of that led by the US, which in sterling terms was at 1.2%. And just on that note, with the interest rate differentials we're seeing between the two, if you think of the UK and the US, you saw real strength in sterling yesterday as well. So if you compare sterling to the US dollar, it's actually up 0.5% yesterday. If you look into just the US equity performance, a lot of it was broad-based, but generally led by tech. So there's magnificent 7 names such as Nvidia, Apple, Google. They were leading the way really after, to be fair, with something that's been they've had a bit of a choppy couple of months in terms of the volatility. So that they've led the way in that sense. You also saw some good performance from maybe more growth sensitive sectors such as industrials, materials, financials. So yeah, that was positive in the US as well. On the commodities side of things, you've seen gold actually touch into new highs as well. So
it's a pretty broad-based strength, albeit a little bit choppy at times, but US markets, gold reaching all-time highs. Currency, as you talked to the pound up to 133 against the dollar. Good news for when you're next going on holiday, I think.
Absolutely.
Excellent. Thanks, Joe. And thank you very much for watching. If you do like the content, then please like and subscribe. And we'll look forward to seeing you next week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.